Listen to me very carefully. What I'm about to tell you is not speculation. It's not theory. It's happening right now, this month, in February 2026. And the financial media won't touch this story with a 10-foot pole. Because if they did, the panic would start before the banks are ready. Over the last few weeks, something has been unfolding in the silver market that violates every assumption Wall Street makes about futures exchanges. And what I've found is a mathematical trap that's about to spring shut on some of the largest financial institutions in the world. We're talking about Shanghai. We're talking about China. And we're talking about a rule change that went into effect exactly 11 days ago that has effectively ended the free market for silver in the world's largest manufacturing economy. But here's what nobody's telling you. This isn't just China protecting its industrial base. This is China front-running a global supply crisis that they know is coming. And the reason I know they know it's coming is because of what they're doing with the physical metal right now. Let me show you what just happened. On January 22nd, the Shanghai Futures Exchange issued a regulatory update. Buried in technical language about margin requirements and position limits, there was one sentence that changed everything. Starting immediately, the exchange would reduce the daily opening position limit for silver futures to 800 lots. That doesn't sound dramatic until you understand what it means. It means if you're a speculator, if you're an investor, if you're anyone not approved by the Chinese government, you can no longer accumulate meaningful positions in Shanghai silver futures. But that's not even the real story. 3 days later, on January 27th, they did it again. They raised margin requirements to 11%. They expanded price limits to 9%. They banned 16 trading firms from opening new positions for an entire month. Not for fraud, not for manipulation, for disclosure failures. What does that actually mean? It means those firms were trying to take delivery of physical silver, and the exchange needed them to stop. Now combine that with what happened on January 1st. China reclassified silver as a strategic material. They implemented export licensing requirements. They published a list of exactly 44 companies approved to export silver for the next 2 years. 44, down from over 100 the year before. And to even qualify for that list, you need to produce at least 80 tons of silver per year and maintain $30 million in credit lines. Those requirements just eliminated every small and mid-sized refiner from the export market. Do you understand what that means? China controls between 60% and 70% of the world's refined silver supply. Not mining, refining. They take raw silver from mines all over the world and turn it into the bars and granules that manufacturers actually use. And they just told the world that metal is staying in China, the window is closed, the gate is locked, and the price hasn't even begun to reflect that reality yet. Because here's what's actually happening on the ground in Shanghai right now. Physical silver is trading at a 12% premium over the London spot price. 12%? That's not a normal arbitrage spread. That's not transaction costs. That's the premium you pay when there's no metal available at the official price. The paper price on your screen says silver is $85 per ounce. But if you're standing in Shanghai trying to buy actual physical silver today, you're paying $95, and that gap is widening every single day. I talked to a source at a trading desk in Hong Kong last week. He told me something I couldn't believe at first. 2 Chinese manufacturers contacted a Canadian silver producer offering to pay $8 to $10 per ounce, above market price for immediate delivery. Not for delivery in March, not for delivery in 6 months, right now, today. They're willing to pay premiums that would have been unthinkable 6 months ago because they know something the rest of the market hasn't figured out yet. The Chinese government isn't just protecting strategic reserves. They're preparing for a scenario where Western silver markets stop functioning entirely. And they want every available ounce locked down inside their borders before that happens. Now, let me show you why they're right to be worried. Let's talk about COMEX, the New York commodity exchange that's supposed to be the global price discovery mechanism for silver. The exchange where futures contracts are settled. The exchange where manufacturers and investors are supposed to be able to convert paper positions into physical metal. That exchange is showing stress fractures that are getting impossible to ignore. Since October, COMEX registered silver inventory has dropped from 167 million ounces to approximately 103 million ounces as of early February. That's a decline of 64 million ounces in 4 months. Now you might say, well, they've got 103 million ounces left. That should be fine. Except that's not how the math actually works, because registered inventory includes silver that's already allocated, already pledged, already spoken for by other contracts. The amount of truly free, unencumbered, deliverable silver sitting in those vaults is much, much smaller than the headline number suggests. And then January happened. January is not supposed to be an active delivery month for silver. It's a minor month. Historically, you see maybe 3 to 5 million ounces delivered in January. The contracts are supposed to roll forward to March. That's how the system normally works. But in January 2026, somewhere between 33 and 40 million ounces were delivered. Delivered. Not traded, not rolled. Actually removed from the vaults and taken into private custody. That's roughly 26% of registered inventory that vanished in a single month. A month that wasn't even supposed to see significant delivery activity. Why would anyone demand January delivery instead of waiting for March? Because they knew that by March, the math would be impossible. They knew that everyone else would be trying to get through the same door at the same time. So they paid premiums to pull their delivery forward. They accepted worse pricing on January contracts to guarantee they could get metal out of the system before the crowd showed up. And now we're 16 days away from March first notice day, the day when holders of March silver futures contracts must declare whether they're taking physical delivery or rolling their position forward to May. And the open interest in March contracts represents approximately 500 million ounces of silver, against available registered inventory of maybe 103 million ounces. But remember, not all of that is actually deliverable. If you account for allocated positions and encumbered metal, the real free float could be closer to 70 or 80 million ounces. So what happens if 20% of March contract holders demand delivery? That's a conservative estimate based on historical patterns. 20% of 500 million ounces is 100 million ounces. COMEX doesn't have 100 million ounces of free metal. If 30% demand delivery, we're talking about 150 million ounces against maybe 70 million available. The math doesn't work. It can't work. And everyone in the institutional silver market knows this, which brings us to the question nobody wants to ask out loud. What does COMEX do when delivery demands exceed available supply? They have three options, none of them good. Option 1, deliver everything they have and declare force majeure on the shortfall. Force cash settlement on the contracts they can't fulfill. Publicly admit that the exchange cannot guarantee physical delivery. The moment they do that, confidence in COMEX as a pricing mechanism evaporates overnight. Every manufacturer using COMEX for hedging immediately starts looking for alternatives. Shanghai, London, private deals directly with miners. Anything except an exchange that just admitted it can't fulfill its basic contractual obligations. Option 2, invoke emergency powers before first notice day even arrives. Change the rules in the middle of the game like they did in 1980 with Silver Rule 7. Ban physical deliveries. Force everyone into cash settlement whether they like it or not. Triple margin requirements. Make it prohibitively expensive to hold positions. This keeps the exchange operational in the short term but destroys long-term trust. Who uses an exchange that can unilaterally void delivery obligations whenever it becomes inconvenient? Option 3, let it run. Do nothing. Allow market forces to clear the imbalance through price. Silver spikes to $120, $150, maybe $200, as banks desperately source metal to cover short positions. Massive losses. Heads roll. But the system maintains credibility because contracts were honored. The exchange survives with its reputation intact even if some participants get destroyed in the process. Based on history, based on 1980, based on 2011 when they raised margins 5 times in 9 days to crush a retail silver squeeze, the most likely outcome is option 2. They'll protect the banks. They'll change the rules. They'll force cash settlement because that's what they always do when the system faces existential stress. But here's why February 2026 is different from every previous silver squeeze attempt. The buyers are different this time. In 1980, the Hunt brothers were retail speculators. When CME changed the rules and raised margins, they got wiped out and went bankrupt. The squeeze ended. In 2011, it was retail investors from Reddit and YouTube buying silver eagles and small futures positions. When margins went up 84% in 9 days, they sold and went home. The squeeze ended. Silver took 13 years to recover. But who's buying silver in February 2026? Solar manufacturers who need 200 million ounces per year for photovoltaic panels and have no substitute material. Electric vehicle producers who need silver for battery management systems and power electronics. Semiconductor fabs that can't make chips without silver. Data centers building AI infrastructure where every server rack requires silver conductors. Defense contractors making missile guidance systems. 5G network build-out where every antenna requires silver. These are not speculators who panic when margins double. These are manufacturers who will pay 50% or 100% premiums rather than halt production lines that cost millions per day to operate. And China just told them they're not getting Chinese silver anymore. So where do they go? COMEX, London, anywhere they can still get metal. And they're all trying to get through the door at the same time. Now let me show you the other side of this equation, the demand side. Because while China is locking down supply, India is absorbing everything that's left. India imported $9.2 billion worth of silver in 2025. That's up 44% from the year before, despite silver prices nearly tripling. In rupee terms, silver went from around 80,000 rupees per kilogram in early 2025 to over 243,000 rupees by January 2026. The price tripled. And Indian buying increased. That's not speculative demand that disappears. And when prices rise, that's structural demand driven by industrial growth and cultural preference for physical metals. Silver ETF inflows in India hit 234.7 billion rupees in 2025. That's triple the previous year. And here's the critical detail. Indian silver ETFs are required to hold physical metal. When someone in Mumbai buys shares of a silver ETF, an actual bar of silver has to move into a vault in London or Zurich and get allocated to that fund. It's not paper, it's not synthetic. It's real metal that gets permanently removed from the available pool. So you have China on one side, locking down exports and restricting domestic trading. You have India on the other side, vacuuming up every available ounce for industrial expansion and investment demand. And caught in the middle is COMEX, trying to maintain the illusion that paper contracts can still be converted into physical metal at will. The cracks are already showing. Silver went into backwardation in January. That means spot prices traded higher than futures prices. In a normal commodity market, that never happens. Futures should trade at a premium to spot because of carrying costs, storage, insurance, financing. But when spot trades above futures, it means physical demand is so urgent that buyers will pay more to get metal today than to get metal in 3 months. It's a technical signal of extreme shortage. Lease rates spiked to 34% annualized in October. Some intraday peaks hit 39%. That's the interest rate someone will pay to borrow silver for short-term delivery. When lease rates spike that high, it means someone desperately needs metal for immediate settlement and cannot find available supply at normal prices. They're bidding up the cost of borrowing because outright purchase is impossible. And then there's the premium explosion in retail markets. COMEX says silver is $85 per ounce. But walk into a coin shop in America right now and try to buy a silver eagle. You're paying $120 to $130. Generic rounds are $110. Bars are $100 minimum depending on size. That's a 20% to 50% premium over spot. If there was real available silver at $85, why would anyone pay $130? Why would premiums be at all-time highs? Why would mints be running out of supply? Because the paper price is not real. The futures market is a confidence game that only works as long as nobody demands the actual metal. As long as everyone agrees to settle in cash, as long as contracts get rolled forward instead of delivered. But once delivery rates hit 30%, once industrial buyers refuse to roll and demand physical settlement, once vaults start emptying at 2.5 million ounces per week, the confidence game ends. And the people running this game, the banks with massive short positions, they're trapped. If JP Morgan or any other major bank starts buying 50 million ounces in the open market to cover shorts, every algorithm on Wall Street detects the pattern within milliseconds. High-frequency trading systems front-run the orders. The price explodes to $150, $200, maybe higher before they finish covering. They lose billions. Their quarterly earnings get destroyed. Congressional hearings get called. But if they don't cover and COMEX declares force majeure, their reputation takes permanent damage. Who trusts a bank that defaulted on delivery obligations? Who uses them for hedging after that? They're caught between two terrible choices: default and face legal consequences, or cover at any price and trigger the exact short squeeze they've been trying to avoid for years. Now let me tell you what happens next. Because even if COMEX survives March by invoking emergency powers, the structural problem doesn't disappear. It gets worse. May contracts are building. July is loading. Every month faces the same tightening math. Registered inventory still dropping. Industrial demand not slowing. China still hoarding. India still buying. The crisis just rolls forward. And every time COMEX invokes emergency powers, every time they force cash settlement, every time they change the rules to protect banks, confidence erodes further. More manufacturers leave for physical markets. More metal flows out of vaults permanently. More buyers refuse to trust paper contracts. The death spiral accelerates. This is not like 2011 when retail gave up and went home. This is structural. This is industrial. This is strategic. Governments are treating silver like lithium, like cobalt, like rare earths. Materials essential for national security and technological dominance. That demand doesn't disappear when prices fall. It doesn't go away when exchanges change rules. It continues regardless of market conditions. We're 16 days from March 1st notice day. 16 days from the moment when the math becomes impossible to hide. When paper promises meet physical reality with the whole world watching. When the fractional reserve system that has worked for decades faces a stress test it was never designed to handle. In 1980 and 2011, they changed the rules and saved the system because the buyers could be scared away. But this time, the buyers are manufacturers who can't stop buying. This time, China has weaponized supply by locking it down. This time, India is draining London vaults faster than they can be refilled. This time, the math might force a reckoning that exposes how the system actually works. I'm not telling you what to do with this information. I'm showing you the numbers, public data that anyone can verify. 500 million ounces of open interest in March silver futures, 103 million ounces of registered inventory, 33 million ounces delivered in January alone, China restricting exports, India importing $9.2 billion of silver in a single year, backwardation, lease rate spikes, premium explosions in physical markets. Those are facts, documented, published, verifiable. The question is, what happens when the paper price and the physical price can no longer pretend to be the same thing? What happens when manufacturers show up demanding delivery and COMEX has to choose between honoring contracts or protecting banks? What happens when the world realizes that the benchmark price they've trusted for decades was based on a fractional reserve system that only worked as long as nobody called the bluff? 16 days. That's all the time left before we find out if March 2026 is just another delivery month, or if it's the month the paper silver market broke and only physical mattered anymore.